when you look at these different adjacent asset classes or credit asset classes, the returns
Hmm.
aren't always the same.
Yep.
Right. They're just year in, year out. They're just not the same. And there's a variety of reasons. It could be one year rates are ripping and credit spreads aren't doing much. It could be another year where rates are going the wrong direction and bank loans, a floating rate asset class. So people like those. So having that flexibility on where to go and when is really important. There's also some structural, I would say persistent structural opportunities in individual markets. And I would point the broadly syndicated loan market as one where you have one really large investor type that dominates the asset class, which are CLOs. CLOs are structured credit vehicles. For those that don't know in your audience, it's basically a 10 times leverage structure where you take an equity investment and you raise a whole bunch of fixed capital in the form of AAA, AA, and you have a waterfall to return that capital. And then you
Mm,
go out and buy the underlying asset, which are broadly syndicated loans.
got it.
And that vehicle, like I said, it's about 75% of the investor type in that marketplace. And while they offer a great sort of core and stabilizing force, they also don't invest completely on the fundamentals. So
Mm,
their investment is much more about making sure that waterfall continues. And they have all sorts of rules that they have to follow around, concentration over industry on single names. And that drives opportunity.